New info out today. Bankruptcies are up year over year. And hey, let's get the bank to pay for our renovations. Yes, all this and more with our good friend and mortgage broker, Mr. Dion Begg, right after this. Here we are, my friends, back with our favorite mortgage broker in all of the land, Mr. Dion Begg. How you doing, my man?
Hey, Gary. I'm good, man. How's things?
Things are great for a lot of people, and we're going to dive into a few things here, maybe not so much for others. However, here's what we know, Dion. The Canadian real estate market doesn't stop for anybody.
It's true. I mean, and the phone is ringing, I'll tell you that. I think I mentioned this over the last couple of weeks. There's been a lot more inquiry, and even though it may have not hit the streets yet, I know that people start their mortgage process 2 to 4 months before you'll actually see a transaction in the market. So I can tell you that from what I can see, next year Q1 is going to be busy.
Yeah, we're seeing the same thing too. And we have an interesting moment in the market where some sellers that perhaps have been up for sale, for we'll say 2 months-ish, because we do see listings that kind of sit there. They are starting to have those conversations about, do we take them off the market and relist in that new year, where just like every new year, new beginnings, new resolutions, new, and we're just starting to see some of those conversations come through the realtors that we work with, and we're seeing those conversations start happening. So if you start to see some listings come off the market, it's really, really all about the right sales strategies. So don't be surprised if you see that, is what I'm trying to say.
Yeah, and I mean, depending on the market, I truly do believe that these new CMHC, well, insured mortgage changes that are happening December 15th, which is 30-year amortizations, as well as the ability to get insured mortgages up to 1.5 million. I really do think they're going to come into play. And so if you're a seller in that sort of early $1 million mark, it does make sense to maybe wait for more buyers who can come into the market post December 15.
Yeah. All right. Well, we've got a couple of things we're going to talk about, as always, Dion, and Dion's going to share some of his true life, real drama, real stuff, mortgage conversations that he's having with his clients. And one of which is something that I've used many times in the past is, how do I get that bank to pay for the renovations and improvements I'm going to be doing on a house? And it's always a great product, Mortgage Plus Improvements, that I think, Dion, I don't know if maybe not enough people know about it, so it's not used enough. You tell me.
Yeah, I mean, I'll tell you, it's probably used less than, well, on a handful of occasions in any given year, to be frank. And there's other reasons for that, in that some people don't necessarily need the bank to finance in that format. But let me explain what the product is, and then we'll sort of overlay these other things. So we're talking about a product called Purchase Plus Improvements. So that is a mortgage which will, of course, allow you to purchase the property you intend to buy, but also give you extra money to help you renovate that property and improve it to a certain standard. I personally used this product years ago on my first family home, where we bought a property. When we closed on it, I knew that we wanted to finish that basement. So we made the application for about, I think it was an extra 50,000 just to finish it, and that's what we got. So there's a couple of little tricks and logistical things that do surprise people around this product, which we should probably talk about today. So I'll use sort of just round numbers today. Let's say you go off to buy a property for 700 grand. Okay, and you know that you want to finish that basement, or do a kitchen, or update a bathroom, and let's say the cost of that is going to be $70,000. Okay, so what will happen is we will go to the bank, we will get the mortgage for the initial 700 grand purchase price, and keep in mind we'll get you a percentage of that purchase price. So you might be putting down 20%. Or you might be putting down less than 20%, which you can do. These mortgages, these Purchase Plus mortgages, are available under the insured banners as well. Okay, so now you got a property, you want to buy it for 700 grand. You put down, let's say you put down 10%, so you put down $70,000. Okay, but you need an additional 70 grand to do the reno on the property. So what we'll do is we'll put in an additional request and tell the lender, hey, my client intends to do this work to the property. Could you please lend us another? And in fact, let me continue with the example. It's 70 grand going to be the cost of the reno, and we're getting a 90% loan. So they're not going to lend you $70,000, right? They're going to lend you $63,000 in this example, right? 90% of that number. So we would get approved for this additional $63,000 for renovation. Okay. So that's great. Now, here's the thing, most people think they're going to get that money the day the deal closes, but that's not how these mortgages work. Okay. So what happens with these, and this is what catches people out, they actually have to have their own funds ready to do the work first, the 70 grand worth of work. Then we need to prove the work is complete, either by an appraiser's visit or proof of invoices paid. And then the lender will release that $63,000 to you after the fact. And so if you're interested in this product, while it's great, you still have to front that, in this case 63 grand, either from your own money, or what I've seen many people do is lean on parents, right? Or lean on other credit facilities, credit cards, lines of credit at higher rates, knowing that they will be able to wipe those credit cards out in a matter of 2 or 3 months when they get that money back from the bank and that 63 grand is released.
Yeah, it's a great product. Like you said, you've used it, I've used it. and and there's a few factors into there, right? We have to go get not only a contractor's quote, right, to submit with the transaction. That typically that same contractor has to complete the work, and that money. Correct me if I'm wrong, Dion. The entire sum, so the amount of money that the bank or the lender is going to be providing, that amount that sits or that is going to be used for that renovation, it's already dispersed into your lawyer's trust account. Am I right there?
Right. So it is on hold, so
Yeah.
to speak, but you are paying interest on it. The point being, yes, you are paying interest on it because it has effectively been allocated to you, right, as a borrower. So just do keep that in mind as well. So, earlier you said, Gary, not many people use it. And it's because in many cases, people don't necessarily need it if they themselves have access to that 60, 70 grand and they're like, well, I don't really need to finance it. But there are instances, and I'm dealing with one right now, where a client does intend to, and he's actually going to create a legal second unit in that basement apartment. And so he's trying to do things that way. That's going to cost him close to 90 grand, I believe. But again, he sees the benefit in it. And here's a funny thing, he actually has the cash, he's actually got some liquidity. But he says to me, look, I'd rather get more money from the bank and then leave that cash in my own hands and then go off and do something else with that cash, be it further investing or whatever that might be. Yeah.
Yeah, yeah. And you might be thinking to yourself, why, if I have the money, why go borrow and use it? Or if I have the available credit over here, why do I need it from this lender? And my quick answer to that, Dion, would be, well, perhaps you're borrowing it off a line of credit
Yeah.
or unsecured line of credit or credit card where
Expensive.
that interest rate is so much higher. And
Yes.
on a first mortgage, it's going to be, we'll just call it five-ish, 5.5 or less percent, right?
Yep. Yep. Exactly. So why pay for it with 15 to 25% interest rates when you can do it at fives? Yeah.
Yeah. Yeah. Good
Mm.
stuff. Good stuff. Okay. I like the other story that you brought up, and we're going to get into a kind of a news article also that hit today
Mhm.
about insolvency. But before we get to that, I like I like this idea, and I've done it too with a lot of my, not only first time home buyers but other buyers. They look at properties, investment properties, as their personal residence. So talk to us and walk us through what that looks like.
Yeah. I'll share a story. I was recently, just 2 weeks ago, talking with a client who's in their 50s, and they're talking about the retirement that they're planning, and they're actually going to retire at age 55. And so I'm always curious about, how did you do this? Like and they have 6 properties, they're doing very well. And they said, Dion, when we bought our first home, we renovated the basement and we lived in the basement. They chose to live in the basement so that they could rent the upstairs and get extra money from that upstairs tenant rather than, occupy the main floor. They like, we'll stay downstairs, we'll get extra cash flow. And it's little decisions like that, especially early in life, where you're willing to make those sacrifices, which just compound to so much more later in life. And this is where a perfect example: small sacrifice early, age 55, able to retire, right? And so, as it relates to a situation right now with another client, he's a single guy, and he was looking originally at purchasing a duplex, similar type setup. He's going to live in one of the units. But as we looked at his numbers, he's one of these people who's a bit of a, I would call him a little bit of a unicorn, where he's got very good income, into the 200 plus range, actually close to 300. But he doesn't have a very big down payment, right? He doesn't have 20% down. And when we were looking at the numbers, um, it looks like instead of buying for just say 700 grand, we could actually buy for close to 1.3, 1.4 million. And what that does for him, it opens up not just duplexes, but he's looking at triplexes and 4-unit properties right now. And when we see what's coming up with December 15th and this the amortization extension to 30 years, and the fact that we can buy up to 1.5 million, he's one of those people who can capitalize on that opportunity. So we run the math. We're looking at a 4-unit building where he's going to live in one, rent the others. The others are going to bring in something like 5 grand a month, and his cost of living to live in that $1.4 million property is cheaper than the monthly cost of living to live in a single family home for sure, or even that duplex. So in many cases, buying the more expensive property costs you less on a monthly cash flow basis.
Yeah, I love it. It's just like you said, thinking outside the box, or doing something a little bit differently, or sacrificing something a little bit for that long term gain. And like I said, often we talk to our first time home buyers about, hey, you can live where you want to live, meaning rent where you want to live, and go buy an investment property where your funds go so much farther, in those tertiary markets. And this is another great example of that. Okay.
You bet.
So I talked very briefly about kind of the news that's hitting the news cycles in the Canadian economy world today, and that's some reports coming out of Charles Star and some other things about insolvency, bankruptcies, proposals, all on the up, moving up year over year. And I got some numbers I'll share with you. So insolvencies up 61% versus this September versus last September. Bankruptcies up 27%, and proposals up 250%. So you've been leading and talking us through this over the last several months, not so much about this specifically, but the word that you like to use is the damage has already been done. Talk to us from your perspective on that.
Yeah. So, guys, look, interest rates have dropped. And so, you might be sitting there going, if interest rates are lower, how is it that these numbers are so terrible, right? With bankruptcies and consumer proposals. And the reality is, by the time that these interest rates dropped, yes, the damage was done inside of Canadian households, where the money coming into the household was less than the monthly cost of running that household, including mortgage, utilities, vehicles, food. Everything's gone up, right? And so people were already at their breaking point. We may be only talking about the bottom 5% of Canadian society here, but if they're already on the margins, then these last couple of years before the rate drops have been enough to really kick these guys down to the curb, unfortunately, right? And yeah, I can understand why in any given month. I mean, have you seen the average price of a car payment now? Like, if we go back 10 years, Gary, what was the average price of a car payment?
Oh, okay. This is full on guessing
Put
mode
you on the
now,
spot.
but I'm gonna probably say around $600, maybe
Okay.
down to five.
Yeah. So if we go back 10 years, it was closer to 400. And if we go to today, we're closer to 700 to 800. And I've seen many in the 1,000 plus range,
Yeah.
right? That's the cost of vehicles right now. And so, yeah, these things have all added up. And, 27% bankruptcy increase, 250% consumer proposal increase. And actually, let me just explain the difference, because I see credit bureaus on a daily basis, and sometimes we come across these items for our clients, and we sometimes have to talk to them about the options they have. So consumer proposal is when you go to your creditors, you go to the credit card companies that you owe money to, and say, look, I can't meet your current payment plans, but I want to make myself good with you. So can we, number one, can we negotiate a lower rate, a lower outstanding balance? I owe you 10 grand. I don't think I can ever pay you 10 grand. Could I pay you 7 grand, 5 grand, right? And they might agree to that. And once that's agreed to, then you go into a payment structure with that credit card company. And that might take you anywhere from 3 to 5 years to get through, right? And then once that's done, 5 years from now, you are complete with your consumer proposal. Okay. So that's one option. The other option is you just go to those creditors and say, there's no way I'm ever going to be able to repay you. And in those instances, you declare bankruptcy, right? So this is the crazy thing, Gary. Most of us listening to those two options will see that the person in option one with a consumer proposal is really trying to do the right thing. They're like, hey man, look, I'm trying my best here. I can't make these payments, but let's work something out. And the second person is just like, I got nothing, I'm bankrupt. The crazy thing is, when it comes to your credit report, what banks look for is how long since the discharge of your incident, the discharge. Okay.
Mm,
So let's say that today you're faced with these two choices: consumer proposal or bankruptcy. If you do the bankruptcy, then you are effectively going to be discharged from that pretty much straight away from those debts. Okay. If you do the consumer proposal, you're going to do the right thing for 3 to 5 years, then you're going to get discharged. Okay. And what happens is that person who took the bankruptcy is going to be 5 years from now, is going to be 5 years clear of their discharge, meaning that in the eyes of the bank, they're actually now in a stronger position than the person who did the right thing maybe, and did the consumer proposal. So I'm not giving you advice on this. I'm just saying this is how the banks see these and read these credit reports. And also, these issues, consumer proposals, bankruptcies, the date of the discharge, that falls off your credit report in 7 years. So
right.
if this happened 8 years ago, it's no longer reporting on your credit bureau. You're somewhat forgiven for whatever happened 7 years ago, and you're treated like a brand new client with regular credit. So, and the other thing I'll say too is super important that the minute that you are discharged, or even before that, that you reestablish credit. I've seen so many people go through these issues, Gary, and then they're like, "Oh, yep, I'm never touching a credit card ever again." And so we're 15 years later, they come to me for a mortgage. I could get them one, but they don't have any credit facilities
Right.
because they just said, "Oh, I'm terrible with credit," or "I'm scared of credit." That's not the approach here. You must go and reestablish credit. Even during your discharge process, you can actually get that sooner than later with a product called a secured credit card, where you might give $1,000 cash, they'll give you $1,000 credit card. And you got to make sure it's the right type of credit card, though, the one that does report to the credit bureau.
Mm.
Some of them don't. So again, if you need advice on any of that, guys, feel free to reach out. I can tell you that the type of credit card you'd need to reestablish credit.
Excellent. And my friends, uh, this is one of the main reasons why we host this weekly video series is, educating our listeners or watchers. And if you have found yourself in some of these situations that we've just chatted about, there are ways, and as Dion just shared with us, ways to get out of it and rebuild that and establish that. And there's lots of great opportunities for any type of borrower out there. It just takes a little bit of diligence and talking to the right people, as we always do. My friend, there's lots going on. I think to kind of wrap this video up, we're right in the middle of November. Here's what I know, and we've talked about this in the past. I've helped my clients, and maybe you have as well, as we close out this year. We'll call it 4 to 6 weeks left. We've done some of the best type of transactions as we close out the year. I'm not talking about, undercutting someone's price dramatically, but there are opportunities out there, and look for opportunities. Would you say the same thing?
Yeah, 100%. So I just this week I've had two conversations with clients who said, Dion, we're gonna buy over winter, and both of them have purchased over winter historically, and they said we got the best deals during winter when nobody else was willing to put on their winter boots and get out there and deal with the weather and all of that. So yeah, if you're in that position and you can take advantage of that, you should. And especially with this CMHC changes, the amortization stretching out, I feel like a lot of that will come into effect in the spring market. So if you're one of those people who can take advantage of that prior to spring, before the competition gets crazy, then you may want to move forward sooner than later.
Excellent stuff as always. Remind us how to get a hold of you.
Yeah, kangamortgage.ca or Instagram at the Dion Begg.
There you have it, my friends. That's Dion Begg. I'm Gary McGowan. We'll see everybody in the next episode. Goodbye for now.